Well, we'll see. It's either momentum or an inflection. We don't know if it's momentum. If we roll over, then it's not momentum. I think, look, when you look at Caixin this morning and you see the print there, I don't think that makes for a change in the narrative at all. I think the internals of the ISM number were actually weak. New orders were strong, but backlogs were very, very weak. Retail sales were weak. You know, today's data was the kind of data where you can basically craft whatever narrative you'd like around it. It really, and in
except
terms
for the market did craft a narrative, which was 10-year yields jumped and the market rallied 330 points.
And look, by the way, I think that's really important. I think rates have been doing the Fed's job for it. Global growth has been slowing. Bund yields, JGB yields, they're negative. As you mentioned, this is the first day in a long time we've seen 10-year yields above 2.5%. So that's helped to loosen financial conditions. If that changes in any form or fashion, I think equities are going to start to stall.
You know, the bears are really sticking to their guns. It's not just you. Mike Wilson was on in the last hour. He's chief U.S. equity strategist for Morgan Stanley. He's been cautious really since the end of last year. And he still says there's some pretty big warning signs like earnings. Listen.
The earnings profits recession is real. The mistake was not the Fed tightening last year. The mistake was the fiscal policy timing of the fiscal policy stimulus, which overheated the economy last year. And that was really our call, was that earnings were going to disappoint because there was going to be margin pressure. And we're seeing it in labor. We're seeing it in excessive CapEx last year, which is now being curtailed, and inventory. And so the risk is that the profits recession turns into corporate behavioral change, which then leads to further economic slowdown.
So there's still this idea out there of earnings recession. We're going into an earnings season, and whether the big driver of this is the end of the fiscal stimulus, the waning of the tax cuts, and what that's going to mean for companies and for consumers.
Combined with higher dollar and tough comparisons. Yeah, all that stuff coming into play. And I think the suspense about earnings season is the market is acting as if it's kind of looking beyond first quarter earnings. And so I think until they actually hit, we don't know if in fact the market has successfully kind of cleared that hurdle and said, we can write that off, or maybe in fact they come in better than expected and we can support the market here. But that's where I think we're going to have the back and forth once we actually report.
Peter, what are you expecting for Q1 earnings, and will it move the market?
Well, I think Q1 earnings are, sort of in the bag in terms of the way expectations have evolved in particular. I mean, when we look at what they were towards the end of last year, expectations were for up 7-8%. Now they're down 3 and change. Q2 is going to look pretty much the same in my view. I think we're actually subject to downward revisions for Q2, whereas I think that's actually not part of the narrative right now. I think most people think that the downward revisions are sort of in the rearview mirror, and I think for the full year, I think we could see earnings much closer to 162 or 163 than 167 or 168, which I believe is roughly the consensus now.